The world of finance is developing daily, and there are several new methods of payment for you to use. Today we'll tell you the difference between central bank digital currencies and cryptocurrencies. Also, some stablecoins can collapse. Do you know the difference? No need to worry, because that's what we're here to help you with. So stick around and find out everything you need to know. First up, how are CBD currencies different from cryptocurrencies? CBDCs, or central bank digital currencies, are digital fiat currencies. They can be compared to cryptocurrencies, but they are much more centralized. Central banks issue fiat currencies and must rely on commercial banks to keep their money in digital form. On the other hand, cryptocurrency and blockchain technology has opened a new paradigm in which currency and digital assets can be held and used independently of banks. The difference between cash in a bank account and cryptocurrency on a blockchain is enormous. A bank account maintains a private ledger of accounts and balances to provide service to its customers, but a blockchain network uses a public ledger that everyone can see. The dollar has been in demand on the blockchain for nearly as long as Bitcoin has, which is why dollar-backed stablecoins were established. Blockchain technology enables users to do complicated financial activities that would otherwise be difficult or impossible to perform via the existing financial system. This has resulted in the multi-billion-dollar sector of decentralized finance, or DeFi. The extraordinary capabilities provided by blockchain have piqued the interest of governments all over the world, but they aren't interested in accepting cryptocurrencies over which they have no control. Moving on, let's discuss the dependence of commercial banks. CBDCs are a completely digital version of a country's currency. The primary difference between a CBDC and a traditional digital currency is its dependency on commercial banks. People need a bank account to use a debit card or make automated payments with digital currency, but a CBDC would allow them to do the same thing from a universal account, and you can access this account via smartphones and other devices. A CBDC can travel borders in seconds rather than days and can be programmed for use in apps without the involvement of a bank, and this is the most compelling feature that sets it apart. Most notably, the central bank that produces this digital currency has complete control over its monetary policy and can create or destroy CBDC tokens anytime. As a result, cryptocurrency may view CBDCs as a potentially dangerous technology. So be warned, CBDCs are not the same as cryptocurrencies, even though they use the same technology. CBDCs will utilize blockchain networks maintained by the central banks that issue them, but nothing prohibits central banks from developing blockchain bridges to move CBDCs from their native network to a public blockchain network. Following up, are CBDCs the same as stablecoins? While CBDCs and stablecoins are considered the same, they are very different. A CBDC is a fiat currency created and issued directly on a blockchain by a central bank. A stablecoin, on the other hand, is regular fiat money deposited with a private corporation in exchange for an equivalent amount of the company's stablecoins. In addition, unlike certain stablecoins known to fall in value, CBDC has no chance of crashing. The central bank's digital currencies are still in the early stages of development, but governments are interested in them as the next technological generation of fiat currencies. For example, it is likely that the US dollar will have its own CBDC and will be usable without a bank account within the next 5 years. We can save CBDCs on a phone or other devices. Plus, we can store them in commercial banks. In the same way, we can store cryptocurrencies in a hardware crypto wallet. While regular users may not experience any immediate benefits from utilizing CBDCs, they will help enable monetary policies that digital currencies cannot, for better or worse. Coming up, let's learn more about stablecoins. While Terra's UST stablecoin died, everyone in and out of the cryptocurrency circuit felt it, and the effects were so critical that they brought down various crypto lending platforms, including a multi-billion-dollar hedge fund, dozens of businesses built on Terra's blockchain, and $18 billion in people's money, as well as $60 billion from the crypto market. While this tragedy has made people afraid of crypto and stablecoins, a specific type of stablecoin crashes in this manner. So stablecoins are cryptocurrencies, stable to the dollar, but they are very different from your regular digital currency. They were designed to avoid holding digital currency in an exchange account. Cryptocurrency exchanges have a long-standing history of losing people's crypto and money due to hacks or managerial negligence. Stablecoins are protected from exchange difficulties if we withdraw them from an exchange. They are now the backbone of decentralized finance, an industry that utilizes blockchain smart contracts to rebuild financial services for cryptocurrencies, and it also helps in understanding which ones to trust. Not to mention, all stablecoins have the possibility of collapsing. While all stablecoins can crash, the explanation for this and the risk of it happening relies on the stablecoins version. 101 blockchains focuses on 3 types: fiat-backed, crypto-backed, and algorithmic blockchains. Fiat-backed stablecoins are the most stable, since they are backed by cash or cash equivalents held in a bank account. Crypto-backed stablecoins are less stable than fiat-backed stablecoins. This is because they are supported by collateralized debt positions, cryptocurrency deposits used as collateral to borrow the stablecoin. Finally, algorithmic stablecoins are the least stable, an algorithm that creates or destroys tokens to guarantee their peg supports them. There are commodity-backed stablecoins, similar to fiat-backed stablecoins, but we tie them to a commodity rather than a currency. You should remember that stablecoins are not the same as digital currencies, and digital dollars will not have the same difficulties or benefits as stablecoins. Up next, what causes stablecoins to collapse? All stablecoins have healthy volatility, frequently changing around 0.01% of $1 due to open market buying and selling. They can all become depegged from the dollar during periods of significant volatility. This happens when their market value falls or rises by 1%, but the vast majority may restore their peg. Some, though, can enter a death spiral, which happens when holders lose faith in the stablecoin's worth and rush to cash out their crypto in a frenzy, causing the price to collapse to zero. Because there are no backing assets to be redeemed during extreme volatility, algorithmic stablecoins are sure to suffer a death spiral. To date, we have identified no algorithm immune to mass panic. A quick search on CoinMarketCap or CoinGecko will usually reveal if a stablecoin is fiat-backed, crypto-backed, or algorithmic. If it isn't stated in the token's description, following the website link and browsing the official website will provide the solution. Suppose it's a DeFi application that allows users to borrow stablecoins against their cryptocurrency holdings. This includes Maker Protocol's DAI or Aave's new GHO stablecoin. It's crypto-backed and will only fail if a perfect storm of particular and rare fringe conditions arises. If it's too hard to grasp and lacks any cash reserves or collateralized cryptocurrency deposits, guess what? You should steer clear of this algorithmic stablecoin at all costs. Let's learn how you can avoid a stablecoin death spiral. It is easy to avoid a stablecoin death spiral if its variant is known. While this is a bit of an oversimplification of how stablecoins work and why they fail, it is beneficial for avoiding large losses due to death spirals. Fiat-backed stablecoins are the most stable and durable, almost untouchable, and crypto-backed stablecoins are more volatile but still extremely durable. Plus, algorithmic stablecoins will collapse if everyone panic sells their shares. Finally, the stablecoin exchange Curve Finance hack is explained. Hackers in the blockchain business are becoming more skilled. They recently employed a DNS hijacking attack to steal stablecoins from Curve Finance users. While this isn't a new hacking concept, it does show how the blockchain's decentralized finance DeFi sector can be sensitive to it. Decentralized finance, or DeFi, is a blockchain technology sector that employs smart contracts to build financial services for cryptocurrencies and other tokens, such as lending and borrowing apps or token swapping services. Stablecoins are cryptocurrencies that are tied to the US dollar, and Curve Finance is a web platform that allows you to exchange them in large numbers without experiencing price slippage. Finally, DNS is a computer-readable internet protocol that connects a human-readable website name to its computer-readable IP address. It is one of the earliest internet technologies in operation. When a DNS server's registry is compromised, the hacker can redirect users to their websites instead. It is dangerous if the website is a DeFi or Web3 application like Curve Finance. All these factors combine to form a DNS hijack against Curve Finance. According to a source, the hacker most likely obtained access to Curve Finance's name server and changed their IP address to the hacker's IP address. This ended in the users being sent to the hacker's website, and here a malicious link was installed to steal their stablecoins. That's a wrap for this video. What are your thoughts on central digital currencies and cryptocurrencies? Let us know in the comments below. Please give this video a thumbs up and subscribe to our channel for more videos like this. See you at the next one.